Hey, Andy here. This video covers the absolute basics of debt. Hopefully that'll be useful to you if you want a refresher, or sort of know, but don't totally understand. So first is the term. So debt's typically agreed over a specified term. That means it's agreed over a period of time, with payments made at defined points in that period of time. The longer the term you agree to take out debt, the lower your monthly payment's going to be. That's usually because the payment's made up of principal and interest, and over a longer term, you pay less principal with each payment, but broadly a similar amount of interest. Next up is the rate of interest. APR stands for annual percentage rate, and it shows you how expensive it is to borrow. The way that I think of it is that for every pound I borrow, I need to pay this many pennies every year to service the debt. You pay a fee for taking debt out. That'll also be included in the APR rate, so the interest may end up being front-loaded in the form of a fee, which a lender can show as an APR rate. This gets complicated really quickly, but if you're ever lost, just remember that the APR is the cost of debt every year, the number of pennies per pound you borrow. One of the ways in which a person can lower the cost of their debt is by securing it against a large and valuable asset. This is how a mortgage works. Securing a debt against an asset is a double-edged sword. It will likely lower your interest rate, making it a really appealing option. But it also means that in the event that you end up missing payments, the lender can look to take your asset away. Arguably the most important feature of debt are the agreed repayments. Debt can be agreed to carry any type of payment, from interest only, to principal and interest at regular intervals, to a final payment at the end of the term called a balloon or bullet payment. A loan, for instance, will typically require a monthly payment of principal and interest, and is designed for steady payments over time, with larger amounts allocated to the interest at the beginning of the term, and then smaller amounts towards the end of the term. Credit cards, by comparison, impose minimum payments and typically leave you to determine your own repayment schedule. Repayment terms vary wildly between different forms of borrowing, and often impose different terms concerning when borrowings can be paid off and if they can be paid off early. Sometimes early repayment charges can be levied, so it's really important that you look at the contract and make sure that you understand what terms you're subject to and whether you can afford the repayment terms. Okay, so that was all super interesting. Let's do a worked example. What I'm going to demonstrate here is the impact of extending a loan over a longer term and how that affects interest. So, as a soon-to-be die-hard subscriber, you will discover that my wife and I, Laura, love cats. Let's imagine that Laura finally persuades me that we need to run a cat sanctuary. So here is a picture of our wonderful Pebbles and one of our old cats, Baz. We used to call him Fat Baz. To set up, Laura's cat sanctuary will need to borrow £10,000. And one bank is willing to lend us that money at a rate of 10% over a period of 3 years with no security and monthly payments of principal and interest. Okay, so this is a very standard personal loan. The second bank makes us an identical offer, but they think we're a good risk, and so they're willing to lend us £10,000 at 10% interest over 5 years, payments of both principal and interest. So which is better? Loan 1 or loan 2? So bank loan 1, bank loan 2. All we're going to do here is we're going to work through the monthly cost of having each loan. We're going to then assign the annual payments that will be made, and we will then put through the amounts that it costs you over the lifetime. So the 3-year term will cost Laura £320 per month. 12 payments, 321-ish, give me 3,848. So let's call it 3,850. And over the lifetime, that means I end up paying 11,543. The 5-year loan has payments of £210, which give me a yearly cost of 2,524, so £2,500. and lifetime is 12,600-ish. So if we then remove the £10,000 of principal initially borrowed, this leaves us with an interest cost for the first loan of £1,540-ish and £2,620-ish for the second loan. If we then divide our interest cost by our term of 3 years for the first, we get 514, and by 5 years for the second loan, which gives us 524. I find from these calculations that not only under the longer term do you pay over £1,000 more in interest overall, but you'll also pay a tenner more a year, which I find really galling. In summary, longer term loans are a massive con. Pay them off as fast as you can. If you want to continue getting more practical and actionable information, then please like this video and subscribe to the channel, and I'll see you next time.